Hey everyone, so have you ever wondered how to be an event-driven investor? Well, as an investment actuary with over 10 years investment research experience, I've seen my fair share of investment strategies. So join me, because in this video, I'm going to run through event-driven investing and talk about how you could potentially apply it to your portfolio. So let's get into it. So what is event-driven investing? Event-driven investing is essentially an investment strategy where you position ahead of a predefined event, predicting the direction or the impact on the market of that event. And this can be an extremely profitable investment strategy because some events have massive impacts on the market. Some examples might be positioning ahead of Fed decisions, so interest rate decisions on the interest rates in the US. You might be positioning ahead of election outcomes, so the US elections come to mind. There might be outcomes of referendums, so the Brexit vote comes to mind, or you might be positioning ahead of corporate specific events, so that might be stock splits or earnings announcements. All these things can come out into the market and drive market returns. And the reason why these events impact markets is because they were, up to the point of release, supposedly not known by the market. So as soon as the information comes out into the public sphere, the market reprices, taking that information into account. So if you were going to implement an event-driven investment strategy, here are 3 things you might experience. So point number 1 is that this is actually quite a short-term investment strategy. You typically will want to position just ahead of the event happening and take it off just after the event has happened. And that's because you kind of want to isolate that event's impact on the market, because if you hold the position for a longer period of time, there might be other events and other bits of information impacting the price. You want to isolate that specific market event and its impact on the market. So you position ahead and take off after. So for example, you might be expecting a Trump victory in the US elections just before the election result is known or announced. You might think that a Trump win will be negative for the US stock market, so you position short ahead of the election. Then as the election result becomes known and Trump wins, as expected, the market will sell off. You can ride that all the way down, and then once you've hit your profit target, you can then take that position off. So overall, you might have only had that trade on less than 24 hours, but you could have made, let's say, 2 to 3 to 4%, depending on the stock market move and your position size. So this is something you can definitely implement in your own portfolio. So if you're buying individual companies, you could look at events surrounding that company. So that might be earnings announcements or, new product launches, for example. All these things can have quite a significant impact on the price of their equity. Or you might be looking to position for the market as a whole. So looking at more macro events. In my previous video about macro investing and thematic investing, you can see how those sorts of things can impact the broader market as a whole. Indeed, when I researched macro hedge funds, this was extremely common strategy, particularly the Fed interest rate announcements, because macro trades a lot of interest rates, so we would often be looking for our macro managers to profit from any interest rate announcements from the Federal Reserve, because quite often they would come out and surprise the market, being overly dovish or hawkish, with hawkish meaning that they were signaling higher interest rates than expected, and dovish meaning that they were signaling slightly lower interest rates than expected. And interestingly, it wasn't actually just the hard interest rate decision, it was often just the tone of the statement and specific words that the Federal Reserve members would say that drove markets. So it doesn't even have to be like a hard event. It can be, I guess, the perception of what they're going to do in the future that changes based on the things that they say. And there was a term for that during the QE phase called qualitative easing. So they would talk down the expectations of interest rate rises just by speaking and not actually doing anything to the interest rate itself, which I thought was always quite an interesting concept. And that kind of leads me to point 2 for event-driven investing, and that is that you're not predicting the impact of the event on the market necessarily. You're quite often predicting, 1, what the consensus opinion in the market is, and what the market's positioning for, and how you think the market will react to the event outcome. And they're quite different. And this reminds me of a kind of saying from poker, where you don't play your own cards, you play the person opposite you, because it's the broad market that's going to drive prices and drive reactions, not the theory of what should happen typically. And a great example of this, I'll go back to the US elections. When Trump was elected by surprise in 2016, everyone thought that a Trump win would be negative for equities prior to the event. So quite a few people positioned for that. They were short the equity market going into the election. Trump won, the equity market immediately sold off, so it all seemed very good. But then the market perception kind of shifted and people thought, hang on a minute, Trump, he's very pro-business, this will be good for the stock market, and the stock market subsequently rallied. So it just shows how the broad market consensus and the perception of the market actually drives I guess, the returns more than like the logical, maybe first degree thought about the market. So I guess a key thing about event-driven investing is you have to understand what the consensus picture is in the market. You can do that by looking at fund positioning. You can do that by looking at what other investors are saying, what people are saying in the news, and also just speaking to people on the street. I think Brexit was a great example where if you went and spoke to people on the street, you would find that there was quite actually a lot of support for Brexit. And what you read about in kind of like the ivory towers of the press was not aligned. So really good to cast your net far and wide there. Make sure you're taking lots of diverse inputs to try and understand the broad market positioning and consensus of the people in the real world. And then point number 3 about event-driven investing is that you should have a predefined timeline for your event to play out. So some events have a very specific kind of time attached to them. So like the Federal Reserve minutes will be released at this time, or the election result is due out this day. But other events that you could trade, so corporate events, sometimes don't have a specific day or deadline. So if you think an event's going to happen, you could be waiting a long time. And the problem with waiting a long time is that your IRR, so your internal rate of return, actually comes down the longer it takes for that event to play out, because you're essentially waiting for that event to play out. Nothing's happening, no price moves are happening. If it played out quickly, you could take profit and then reinvest the cash into a new opportunity. So that'll keep the IRR quite nice and high. So this is something you've got to watch out for if it's events that have no specific time attached to them. So when I was a hedge fund researcher, this happened all the time in event-driven credit, because quite often event-driven credit was about taking a company through bankruptcy, and there were various court rulings that had to happen before bond investors got a portion of their capital, and bond prices therefore got reappraised in terms of value. A very good investment strategy when the courts are making decisions quickly, but often these lawsuits get dragged out for a long time, which reduces the IRR on the position, which meant that capital couldn't be reinvested into new opportunities quick enough, and that brought down the overall return of the strategy. So that's just something to watch out for. It's much easier to trade these kind of hard catalysts with hard deadlines, but money can still be made if you take positions with catalysts that have an unknown time horizon. I think you just need to be disciplined about when you take profit or when you give up on that strategy. So there we have it. That was my video on event-driven investing. That actually concludes my series on investing strategies. I hope you enjoyed it. If you want to hear about any other investment strategies, please let me know. I've really enjoyed talking through all these, and it's definitely caused me to learn a lot more about what these strategies actually involve and think through my experience in the past. So thank you very much. And if you want to hear more from me, don't forget to check out this video here.